Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, Financial Navigators. Today, we're diving deep into a fascinating microcap that's caught our attention on the hard-to-borrow screener, VRAX Biolabs Group Limited, trading under the ticker VRAX. We're going to break down why this biotechnology stock is showing signs of intense short interest and what it could mean for its future volatility. Show VRAX logo and stock chart. Let's start with a snapshot of VRAX Biolabs Group Limited at VRAX. This company operates in the healthcare and biotechnology sector, focusing on critical areas like immune response detection, T-cell immune profiling, and developing in vitro diagnostic technologies for viral and immune-mediated diseases. They serve markets in the United Kingdom, the United States, and China, and their VRAX immune product is a key offering. With a market capitalization of just $3.03 million, VRAX is firmly in microcap territory, which often translates to higher volatility and tighter markets. What is cost to borrow and why it matters? Before we get further into VRAX, let's quickly explain one of the most crucial metrics we track, cost to borrow, or CTB. Show cost to borrow text overlay when you short stock. You're borrowing shares and selling them, hoping to buy them back later at a low price. But borrowing those shares isn't free. There's an annualized fee, the cost to borrow. When a stock becomes hard to borrow, it means there are very few shares available and the demand to short them is high. This scarcity drives the CTB fee through the roof, sometimes even exceeding 100% annually, as we are seeing with VRAX. Why does it matter? Because high and rising CTB fees indicate pain for short sellers, and that pain can be a catalyst for a short squeeze. Why the stock is hard to borrow right now. Show VRAX CTB data. Now let's look at why VRAX is on our hard to borrow radar. The current annualized cost to borrow fee for VRAX is an astounding 749.4%. To put that in perspective, short sellers are paying over 7 times the stock's value just to hold their short position for a year. What's more, the CTB fee has shown incredible momentum, jumping by 656 percentage points over just the last 5 trading days. This isn't a slow burn, this is a rapid escalation of shorting costs. Currently, there are only about 30,000 shares available to borrow, which is incredibly low when you consider VRAX's estimated float is only 0.8 million shares. This tight supply, combined with the escalating fees, has given VRAX a composite squeeze score of 60.4 on our internal 0-100 scale, a significant score for potential volatility. Squeeze mechanics explained. So, what exactly happens in a short squeeze? Show animation of short squeeze. Imagine this, short sellers are paying those sky-high 749.4% fees on VRAX. If the stock price starts to move up, even slightly, their losses mount rapidly, compounded by those enormous borrowing costs. At some point, the pressure becomes unbearable. Short sellers are forced to buy back shares to close their positions, which creates buying pressure. In a low-float stock like VRAX, with only 0.8 million shares estimated in the float, even a small amount of forced buying can create a massive surge in demand, pushing the price even higher and triggering more short sellers to cover. This creates a feedback loop, a squeeze, as demand overwhelms supply. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. One of the biggest risks to any short squeeze thesis is dilution. Show dilution risk, non-text overlay. When a company issues new shares, it increases the supply, which can easily offset any buying pressure from short covering and even drive the price down significantly. We ran a check for VRAX and found no recent dilutive SEC filings like -1s, -3s, or 424 BS in the last 90 days. This absence of recent dilution is a positive factor for a potential squeeze scenario, as it means fewer new shares are likely to hit the market. Recent reverse split watch. Another important factor for VRAX is its recent corporate action. VRAX executed a 1/25 reverse stock split just 16 days ago, on June 26, 2026. Show reverse split explanation. A reverse split reduces the number of outstanding shares and proportionately increases the share price. So, for every 25 shares held before the split, shareholders now have 1 share. While often used by microcap companies to boost their share price above minimum exchange requirements, reverse splits also significantly reduce the float, as seen with VRAX's current 0.8 million estimated float. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month following a reverse split. This is a pattern we've observed in some names, not a guarantee for VRAX, but it's an important tendency to be aware of given the recent timing. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what has VRAX been doing lately? Show VRAX price action chart today. VRAX is down 35.85%, a significant drop. However, zooming out a bit, over the last 5 days, the stock is actually up 31.19%, suggesting recent volatility. Over the last 30 days, it's down 23.2%. Volume-wise, today saw 1,719,900 shares trade, but this is actually below its 30-day average volume of 2,653,179 shares, putting its relative volume at 0.6 average. To signal a potential squeeze, we typically want to see strong upward price momentum on increasing volume, coupled with the borrower supply continuing to shrink and CTB fees remaining extremely elevated or even rising further. Short sellers covering their positions would manifest as buying pressure, pushing the price higher. VRAX presents a compelling case study in a hard-to-borrow stock within the volatile biotechnology sector. With an astronomical 749.4% cost to borrow, a rapidly dwindling supply of borrowable shares at 30,000, and a tiny 0.8 million share float, the ingredients for a potential short squeeze are certainly present. Add in the recent reverse split and the historical tendency for post-split volatility, and you have a situation demanding attention. Always remember to conduct your own thorough due diligence before making any investment decisions, understanding that microcap stocks carry significant risks. What do you think about VRAX? Let us know in the comments below. If you found this analysis helpful, please hit that like button, subscribe for more unique insights into hard-to-borrow stocks, and share this video with your fellow traders. Thanks for watching, and we'll see you in the next one.